tend to believe, oh, well, what all these big companies do is they put their IP over in country B, and they charge a license to company A, and they suck all the profits out, and that's a zero tax country, and so they don't pay tax. This is almost entirely false. Anytime a company has to deal with itself in different countries, this creates something called a transfer pricing arrangement. And so they're only allowed to charge a fair arm's length standard, which is fairly aggressively scrutinized by the tax authorities. So they have to do something called a transfer pricing study, and they have to do all sort of extra reporting every year. And if they're found doing what's called transfer mispricing, then they can be fined. In the US, that's like up to 4 times the tax that would be the differential. So it can be quite punitive, and generally speaking, when we're setting up structures for people, we try as much as possible to avoid transfer pricing. Now, the second reason why they don't do this, there's something called royalty withholding taxes. In the US, you're typically talking about a 30% royalty withholding. If you had a company in, let's just say, Bermuda, that doesn't have a tax treaty with the US, and it charges licensing fees or royalty fees to the company in the US, that income it's pulling out is subject to a 30% tax on the gross, which actually might be much worse than just paying the 21% corporate tax locally.